Dell Technologies reported a strong fiscal year 2026 second quarter with record revenue and earnings per share. The company saw significant growth driven by robust demand for AI servers and continued modernization efforts. Key financial metrics for FY26 Q2: revenue reached a record $29.8 billion, up 19% year-over-year. ISG Infrastructure Solutions Group and CSG Client Solutions Group revenue combined growth of 22%. Earnings per share (EPS) increased by 19% to $2.32, a Q2 record. Gross margin $5.6 billion, or 18.7% of revenue. Operating expenses decreased by 4% to $3.3 billion, or 11% of revenue, reflecting internal efficiencies. Operating income increased by 10% to $2.3 billion, or 7.7% of revenue. Net income up 13% to $1.6 billion. Cash flow from operations $2.5 billion. AI performance highlights: Dell experienced exceptional demand for AI servers, booking $5.6 billion in orders and shipping a record $8.2 billion in Q2. This brings total AI server shipments for the first half of the year to $10 billion, surpassing the entire previous year. The company's AI backlog stands at $11.7 billion. Dell highlighted its speed and engineering capabilities in delivering large-scale AI solutions, including early shipments of NVIDIA's GB200 NVL72 and GB300 NVL72 solutions. Segment performance: ISG revenue hit a record $16.8 billion, up 44%, marking the sixth consecutive quarter of double-digit growth. Servers and networking revenue was a record $12.9 billion, up 69%. Storage revenues saw a slight decline of 3% to $3.9 billion as demand moderated, though PowerStore continued strong double-digit growth. ISG operating income was a Q2 record at $1.5 billion, up 14%, with an operating income rate of 8.8%. The company noted that the higher mix of AI business impacted the ISG operating income rate, but expects AI margin rates to improve in the second half. CSG revenue grew 1% to $12.5 billion, with commercial revenue up 2% to $10.8 billion. Consumer revenue declined 7% to $1.7 billion. CSG operating income was $0.8 billion, or 6.4% of revenue, with profitability improving in both commercial and consumer segments due to better execution and product positioning. The PC refresh cycle, driven by the aging installed base and Windows 10 end-of-life, is expected to continue. Management's forecasts and guidance. Q3 guidance: revenue expected between $26.5 billion and $27.5 billion, with ISG and CSG combined growing 13% at the midpoint. Diluted non-GAAP EPS expected to be $2.45, plus or minus 10 cents. Full-year FY26 guidance: revenue guidance raised to between $105 billion and $109 billion, with a midpoint of $107 billion, up 12%. ISG is expected to grow in the mid to high 20s, driven by AI servers. CSG is expected to grow low to mid-single digits. Diluted non-GAAP EPS guidance increased to $9.55, plus or minus 25 cents, up 17% at the midpoint. Significant risk factors. While not explicitly detailed as risks in the provided excerpt, the transcript implies several areas that could pose challenges. Supply chain complexity. Managing large-scale AI deployments, including building readiness, power, and cooling infrastructure, presents complexity. Geopolitical environment. supply chain configurations are subject to geopolitical considerations. PC market dynamics. While a refresh cycle is anticipated, the pace of adoption and competitive pressures remain factors. Storage market shifts. The transition of HCI customers considering private cloud options and increased competition could impact storage performance. Highlights: record revenue and Q2 EPS. Exceptional AI server demand and significant backlog. Strong operational execution and modernization efforts driving efficiencies. Robust cash generation and capital returns to shareholders. Launch of new products, including a business notebook designed for the entry-level commercial PC market. Growing enterprise interest in AI factory solutions. Double-digit growth in key storage products like PowerStore. Lowlights. Storage revenue declined 3% due to moderated demand. North American traditional server demand continued to be challenged. Federal spending remains down, impacting overall demand. Most important statements from CEO Jeff Clarke. We had a strong operational execution in the second quarter with record AI shipments. Our revenue was a record $29.8 billion, up 19%. Earnings per share increased by 19% to $2.32, marking a Q2 record. AI remains a significant tailwind. We continue to see strong demand for AI servers. We booked $5.6 billion in orders in the second quarter and shipped a record $8.2 billion, resulting in an ending backlog of $11.7 billion. Our innovation engine is firing on all cylinders, and the opportunity is showing no signs of slowing down. We really like our hand. Most important statements from CFO Yvonne McGill. In the second quarter, we saw record revenue and also delivered a Q2 EPS record. Our total revenue was up 19% to $29.8 billion. Gross margin was $5.6 billion, or 18.7% of revenue. Gross margin rate was driven primarily by a mix shift to AI servers due to record AI shipments. Operating expense was down 4% to $3.3 billion, or 11% of revenue, as we continue to unlock efficiencies and modernize our processes. We are raising our AI server shipment guidance by $5 billion to $20 billion, with shipments slightly weighted to the third quarter. We expect Q3 revenue to be between $26.5 billion and $27.5 billion, up 11% at the midpoint of $27 billion. We are raising our full-year revenue guidance and now expect FY26 revenue to be between $105 million and $109 billion, with a midpoint of $107 billion, up 12%. We are increasing our diluted non-GAAP EPS guidance to $9.55, plus or minus 25 cents, up 17% at the midpoint. The call concluded with management expressing optimism for continued growth and value creation opportunities, particularly in the AI sector, and reiterating their commitment to profitable growth, modernization, and strong capital returns to shareholders.